Um, Thanks everyone for being here. Quick show of hands, how many people have been on one of these sessions before, these Born to be Sales sessions? Okay, fantastic. Or perhaps as the FS Tech Coffee Club. Well, if this is your first time joining us, my name is Barry Cranford, one of the organisers of the event, as well as Sam and Jon Freedman. So this community started life as the FS Tech Coffee Club. It was something that was our attempt. I worked with Sam for the last 5 years, and we wanted to build a bit of a community, a series of events around the work that they do in the fintech financial services space. So we had the FS Tech Coffee Club, and it was a series of panel events in which we dug into some of the technical issues in the area. And then we came across an event, I think it was the FinPrime event, where it was this fascinating opportunity to really dig deeper into this small part of the fintech ecosystem that we didn't have that much prior knowledge of. It was so interesting that we started to try and do that more and more and use individual companies and their founders and their stories as a way to dig into these new areas. Seems to be a really popular way to go. So we abandoned the FS Tech Coffee Club and we're back with Born to be Scaled to capture that is really what we're trying to do, which is interviewing founders of companies that either have scaled, are going through a scaling journey, or are about to scale. So we're joined today with Jack Allman and James Jackson. Just one final thing I'll say from me, and I'll hand over to Sam and Jon. There is a document I'll be sending out, which is a chance to we'll have everyone's LinkedIn that's involved in the event. But if you want to add your LinkedIn and use this as an opportunity to connect with others who are in a similar space or interested at least in a similar space, then please do. Anyway, without further ado, Sam, I'll hand over to you to take it from here.
Yeah, thanks very much, mate. And thanks everyone for joining us today, in particular our guests, as Barry said, James and Jack. And we're here to learn from them today about the company they founded, Bumper, which is in the automotive repair financing space. Fascinating stuff. And as always, Jon and I have spent some time with our guests, James and Jack, to really dig into their business. And we've constructed kind of 5 or 6 questions that we're going to ask them. And hopefully that'll give them the opportunity to describe to you their business. But just to reiterate what Barry's pointed out, the coffee club we loved, but I think we recognized that no one was drinking any coffee, so it became increasingly badly named. Oh, thanks, Neil. That's very kind of you. Firstly, we'll address the jumper situation. These are the llamas, and I was telling Jon and Barry just now, I've had this sweater for about 6 or 7 years, and I bring it out at this time every year. And it took about 5 of those years before I realized that these weren't actually reindeer; they're llamas. And it was someone in a bar that finally tipped the balance. She said that those are great llamas in your sweater. I was like, for the final time, these are reindeer. Like, why did everyone keep thinking it says la la llama on the front? So as a nod of the head towards me being a dunce. Anyway, so we've done a rebrand, and I hope that you all enjoy the new name. I think, to be honest, we wanted to get the rebrand in before we really exploded in popularity, before we hit the 10,000, 15,000 viewers mark. And so best to get it done now and bed in the new brand before we really go for the moon. But look, that's enough for me. Thanks everyone for joining in the lead up to Christmas. Jack and James, I want to hand over to you very, very quickly to introduce yourselves, but also by way of doing that, could you tell us the founding origin story? Like, what was the hook, the moment when you realized that there was a gap in this repair financing market that no one else had figured out and you were the best people to do?
Thanks, Sam. Yeah, I'll jump in first, I think, if that's all right, Jack. Hi everyone. I'm James, one of the co-founders and CEO of Bumper. I guess just to start off a little bit with my background. So I started my career on a grad scheme doing my ACA accounting exams. Actually ended up failing a few of those and never qualified. But it was a great base for starting a business, being a founder, kind of being comfortable with P&Ls, balance sheets, the rest of it. So good training. I then worked for a couple of tech businesses, more in kind of product and marketing. So I was at Betfair, I was also at B Sky B, and I was also at, I guess now for any Brits who are listening, at Wongo, which is, I guess infamous in many ways. Did some things really well, and did a few things that we've learned from and helped to avoid from some of their past mistakes. But while I was there, I launched a product called Pay Later, and this is one of the early concepts of buy now, pay later. But it was failing because of the Wonga brand had become quite toxic. However, the concept of spreading the costs of purchases struck me as a product that would have huge potential. And it was when I was getting my car repaired at a dealer in my late 20s, having an enormous bill, and then realizing that I didn't have enough money in my bank account to cover it. And it was that quite embarrassing conversation with the dealer to see what I could do to solve that problem. And I was gobsmacked to discover that there was no other options other than paying the full amount. So fortunately, I had family who could transfer some money and pay for it. But that was really the kind of realization that there wasn't enough flexibility in payments, and not really where the idea stemmed from.
I'll jump in after that just to give a similar intro. So yeah, nice to see you all, and thanks for having us on. So my name's Jack. I'm the co-founder alongside James, and I am the Chief Commercial Officer. Much like James, I'll give a brief background to myself pre-Bumper, as it's very, very relevant to what we do today, as you'd imagine. So before Bumper, and at the point I was introduced to James, I worked for my family's business, and they had an automotive focused software business, and they had two SaaS platforms in automotive, one to do with lead management and I suppose the sales side of the car industry, and the other to do with repairing cars, the latter of which being most kind of pertinent to certainly what we started life as, and is still the cornerstone of the business today. And as you teed up, Sam, at the start of the call, that kind of focus area of repair finance, albeit we've broadened out to that from that, which we will explore obviously further in the call. But this platform drove a process that I guess ultimately highlighted the challenge that James just spoke about. So it was what's known as a vehicle health check platform. And for those of you that have got cars and have had them repaired, it's probably a process a lot of you have seen yourself. When you take your car in, they do an initial visual kind of health check on the vehicle in addition to the reason you've taken your car in. So for your service, your MOT, etc. And at this point, they'll be identifying items or parts on the vehicle that have degraded through mileage and usage. So wear part items such as tires and brakes and so on. And they categorize them into a traffic light system of red, amber, and green, which some of you may have seen on these reports when you've taken your car to get it repaired. Red is safety related, amber is advisory, get it done now or in the near future based on your mileage, and green, everything's okay. The most important thing about all of that in the story of Bumper is that it's a very robust process, but ultimately what we saw as a data point in my family software is that actually only about 40%, 40 to 50% of all of this identified and necessary work is authorized. So you have this big chasm, and equally, if you think about it, the dealership has spent time getting that car into the workshop, onto the ramp. A technician who's paid by the hour has identified work that's due. So really, the goal there is to optimize at that point, and that means ensuring that the driver has a fully repaired, safe vehicle, etc. But for one reason or another, 60% of this work isn't getting authorized and done. And I think it's fair to assume everybody wants to drive a safe car, but for some reason they're not getting that work done. That assumption leads to a situation that James articulated, that for a lot of people, that's a price and affordability-led challenge, and they don't get the work done. They defer it to later. They go and seek what they perceive to be cheaper alternatives. Either way, a poor experience for dealer and driver. That's what that software is a process that it drove, and that's the consistent data point we saw in the UK. We had dealerships that we work with in mainland Europe and in South Africa and further afield. So the problem that James just spoke about on a personal level was something we could see actually was a very widespread problem for us to try and resolve. And it was while working there that I was introduced to James through a mutual contact within Peugeot Citroën. And that's really the genesis for how James and I were introduced, and really the catalyst for how we started as what was originally called Auto Service Finance. before we then rebranded and renamed to Bumper.
Yeah, it's an interesting mix of experiencing a problem in James's case that many of us can relate to when we've taken our car in for something that was rattling and gotten quite a large bill at the end of it, and then your family expertise in that area. And I think we see founders who come together with the problem and the domain knowledge, and that's how successful businesses get incubated. A big part of your starting point is that family connection, and that can be unusual. So we wanted to ask if you can share a little bit more about what that looked like, and also did it give you more freedom or more constraints than I guess raising money from people you aren't related to and don't sit down for Christmas dinner with?
Yeah, I mean, I think I guess to go through the process, step by step. So I had this experience. I then, as Jack alluded to, was introduced to someone who was head of innovation and agile work processes at Peugeot Citroën, and he approached me when I was launching the product Pay Later to see if we could launch a similar product for Peugeot Citroën, because he had done a lot of internal research and established that about £1 billion a year of identified repair work wasn't getting sold just for Peugeot Citroën. Wow. And so he came to me while I was working there to say, hey, look, this is our problem. How do we solve it? And I then went and spoke to my bosses and said, look, this is a huge opportunity. We should build something bespoke for automotive. And they were like, yeah, I love the idea, but we've got 1,000,001 other projects we're working on. We just don't have the resource. So I kind of went back to them a few more times, and then it was a no every time. And I was like, right, I'm going to do this myself. And spent a lot of my evenings and weekends working on this concept. I'd approached another small startup who had a loan management system for actually payday lenders, and it was a white label tool. And they were prepared to build a prototype for this. And then we went away and got a number of dealers who were willing to work on it. And I also had an investor who was not a non-family investor to back it as well. And they were actually, it was called Wellesley's, and it was one of the early, this is like 2013, 2014, a peer-to-peer lender. They've actually subsequently shut down. And the concept was they were going to put some equity in, but then also through their peer-to-peer lending platform, fund the loan book. So I kind of had the product, I had the loan book, and I had a bit of equity to grow it. So everything was looking really rosy, about to launch in a couple of their Peugeot Citroën dealers. However, for whatever reason, they got cold feet and pulled out. So it was a bit of a stressful moment to then try and find some other investment. Unfortunately, my dad gave me a bit of a small kind of 50 grand loan, which allowed us to kind of get off the ground. And then at the same time, as Jack mentioned, I was introduced to Jack as well. And I think probably the key element there was to realize my limitations, and gave away some equity to Jack and also his father, because they had the network. They had 2,000 dealers, and it would suddenly allow us to scale a bit faster. So fortunately, with this first check, and appreciate it was very privileged to have a family member, and my dad didn't always have cash, but I was fortunate that at that moment he had a bit of extra cash, and he was willing to, and I think he was excited by the concept to put enough in to kind of get us going. And I think it was back in October 2014 we had enough cash liquidity to write our first few transactions in that Peugeot Citroën dealer. But yeah, as I said, it allowed us to do it on a real shoestring, because we had effectively a sales team, a go-to-market strategy through Jack and his family's business, without having to pay any salaries. So, Jack, again, worked for free, I worked for free. And we kind of got enough traction and enough early momentum to prove the concepts before we then went out to external investors to do our first seed round.
It's really interesting that conversation with innovation at Peugeot Citroën. You're effectively saying they themselves recognized $1 billion total addressable market and still said no. So this is a theme we will come back to with our next guest as well. These large incumbents who can either don't even see the opportunity, or when they do identify an opportunity, they're so big that they can't react to it, and that really opens opportunities for startups and for entrepreneurs to fill them. So that borrowing of technology, of sales team, of salary and time, those are common signals. I think Sam referred to this as ramen before, like this concept that when you do a startup, nobody's getting paid, you can't afford to eat much anymore. But there's a lot of fortuitous connections that help you grow. So you started doing transactions, but not a huge number. What signals were you seeing that convinced you this was going to work, and you were right and the Peugeot guy was wrong?
Should I jump in that one, James? Yeah, so I guess a good way to think about that is that in terms of that go-to-market or that distribution, as James touched upon, with my family's business, working with many franchise dealers already, so main brand dealers, and us seeing this consistent data point or challenge for a lot of them, or I suppose thinking more positively about that opportunity, to optimize the cars that are already coming through their workshops. We spoke to a couple of probably some of the more progressive, kind of forward-thinking dealership groups that we were working with at the time, and some of them put their hands up and said, "Yeah, look, I recognize this is a problem and an opportunity for us to resolve." And they said, happily trial what was a very basic version of what we have today, effectively. So we started out with four installment product, was it, James? No, it was 3 installments, wasn't it? It was just a 3 installment product, nothing to pay on the day, with three future payments deferred at monthly intervals. And that was it. Really, really basic. I sort of look back to some of our early presentation decks and pitch decks and platform, and it makes you cringe at what we were putting in front of very respectable customers and car manufacturers and investors. But actually, probably at its time was, I was going to say good enough, but that's probably unfair to what it was. It was actually probably, on a real par with what was out on a more broader kind of fintech sector, albeit probably not named as such, or certainly not as kind of well known. But what we started to see is that things take a bit of time to get off the ground, and it did take a manual kind of influence to go there, speak to these car dealerships that have been doing business for years, right, in a certain way. So cars come in, you get them repaired, people say yes or no to work, and you hand the keys back at the end of the day. There's far more complexity, obviously, that sits around that, but there's a fairly kind of given status quo. So fortunately, there were people who were open-minded enough to kind of run with that. And we started to see the transactions really start to kind of tick up quite nicely. And what we also saw was like a range of different transaction values. So this wasn't just those with no money that started to use it, right? Because we saw actually lower average transaction values than we perhaps anticipated, and we saw extremes of that. I think from memory, we started doing anything between kind of £100 to 1,000, or was it up to 1,500? But we saw kind of everything at that upper end, and it started to open our eyes to think, well, actually, people's affordability is obviously very personable. So you start to think this is actually a much bigger audience than we first thought. What £100 to one person means entirely different to what it does to another person, and those that need to borrow £1,000, etc. So not only did we see a range of the dealership brands that we started to work with open up, but also the customers within those brands was a very kind of broad mix, where you start to realize there's like an affordability and a convenience type customer at play here. And I think that's really when we got very excited about it, that it wasn't just like a volume brand with an assumed probably less affluent driver. So I think Ford, Vauxhall, Peugeot, Citroën. We actually started to see the more premium end of that, not quite luxury, but Audi, BMW, etc. We're not in the Ferrari territory at that point, though we do work with pretty much all brands these days. But we saw a whole range of customers, both the end consumer, the driver, but also the dealer, start to say this is a product that we would actually start to like to use. And once that started to gather momentum, and then the manufacturers started to take note of it as well, that's when we started to think there's actually probably something really exciting here. And I think you're probably familiar, but obviously the UK car industry works on a franchise model, albeit there's some broader macro changes that are at play there. But so once the retailers kind of pick a product up, then the manufacturer might then get interested. They kind of create some standards for the network, and then they kind of promote and endorse. And I think that's really where we started to see things accelerate and snowball in parallel to the funding story that James is very much leading from our point of view, starting to gather pace as well around that broader fintech space or sector starting to blossom as well.
Yeah, those are very strong signals that you're doing something right if the big manufacturers and franchises start to look fondly at what you're doing, right? Yeah. I think that there's for the folks that we speak to, and our audience will have tired of me saying this, but we speak to a lot of success stories, right? And the nature of a success is that there are steps along the way that have been successful, right? We call like kind of inflection points in your business, the things when, maybe okay, I mean, it's a terrible metaphor given your guys' job, but like a gear shift, right? and you touched earlier on this software stack that you were using, and I think this is a fascinating story because I like it when people that think they have an idea of what their business is go and do something else. Like, just tell us about the loan management technology that you were using and the little story about what happens there.
Yeah, so we as I said right at the beginning, we got our MVP out based on using a loan management platform. Now, this was used by payday lending businesses. I think they had 50 odd different clients. And this was kind of right at the time when quite a lot of US payday lenders coming to the UK using these types of platforms and scaling relatively fast. However, the regulators came in, they put caps on the APRs, and suddenly, there was no margin. And, rightly so. These businesses weren't necessarily great for society. So this business that was providing the management system for us suddenly overnight had only one client left. That was us. So we were in quite a fortuitous position to actually put in a bit of a lowball offer to buy the technology to use it for our own needs. So we ended up buying it for, God, I can't remember, like 25 grand or something. Might have been a bit more, but it wasn't much. So we took it off their hands. We were going to hire the guy who'd built it, the CTO there, but he was way too expensive. We couldn't afford him. He kindly offered to interview developers who could kind of take over the responsibility of it. And we were really, really, again, fortunate. And I think now going through these conversations, reflecting just how lucky we were in so many instances in the business. But yeah, we're very, very fortunate to be introduced to Pasha, who's still 11 years later, still our CTO. He had very smart guy, technical background. He did a master's in Southampton, and but also had a couple of other startups that had failed in Turkey, actually. And he came on board. He was amazing because he was young, so he could really get stuck in and do a lot of the kind of granular, writing codes, all the kind of things that are crucial for the early days. But actually, we're fortunate that he then was also great at being a leader and managing teams. We have between product, data, and tech, he probably has a team of 40 now, and he's an amazing leader and a great developer. So he's been able to develop into a leadership role from the initial requirement. So he then came on board. We owned the software. He then became supremely knowledgeable in the product itself. And over time, actually, I mean, there's no trace of that loan management system in our code today, but it was essential to kind of get us out the door and doing those early transactions.
And previous to that, your transaction rate, you said, had been quite low, like a handful of monthly transactions. When did things really start to take off for you? I mean, you've got the backing of the manufacturers. You've been able to expand into the EU. Was there a point when you knew that things were going to go well, that you were going to blow up?
Yeah, I mean, I think the main inflection point was COVID. Our growth was solid before then, before 2020. So for the first 6 years, it was good, but it wasn't exceptional. And frankly, we hadn't had institutional investors. We had a lot of good angel investors, but it wasn't until after lockdown where we had our Series A and we had our first institutional investors, and that all came from the digitalization of dealers. Now, it sounds obvious. You would have thought in 2020 you wouldn't need lockdown to incentivize dealers to become more digital, but unfortunately that's what it took. So it was that realization that actually dealers need to be able to approve repair work and pay for repair work online on their phone, not having to do transactions in store. So it allowed us, it was an excuse to go to all the different software providers in automotive to embed our product into theirs. So it meant that we weren't reliant on the staff members in the dealer to mention it to the customer. It meant that it could be digitally offered to every customer. So you had that consistent digital experience for every customer. And really, that's when we saw growth to really, really accelerate. I guess in terms of a bit of scale now, we'll do £2 billion worth of repairs through our platform this year. Last year, it was 400 million. So it is really, really accelerating. Next year, we're hoping or expecting to hit 5.5 billion. So it's really, really scaling now. But unlike a lot of businesses that you read about, ours was probably 6 years of hard graft where it was steady growth. And really that digitalization, embedding our products, really was that big takeoff moment, the real inflection point. And with that, being able to demonstrate that growth, we brought in Autotech Ventures, who are Silicon Valley based VC, the world's largest mobility fund. They came in, and that Series A gave us the fuel, if we're continuing on with the metaphors, to really
did those
accelerate.
things all happen at once, James? Like you had the software platform and you were fully digitized on your platform. You and a sales team were going into these workshops, which I've had a car. I don't spend much time in mechanic shops, but would think of as quite like conservative places, quite against digitization. Is that fair, or is that?
I think I don't think they're necessarily against digitalization. I just think it's probably an area that's been ignored largely, and probably hasn't had the investment that it perhaps should have. There's a huge amount of investment and obviously technology that goes into the product, i.e. the car itself. Never more so than now, perhaps, with electric vehicles coming. But probably the systems that sat around that were probably, what's a good way to describe it, like super functional, like incredibly good at what they needed to do, but probably not very optimized thereafter, particularly around thinking about the way that the consumer, that driver, may interact with those systems. Equally, there's a whole host of legacy with a lot of the kind of core technology stack of a dealer that, through requirements of various integrations, have to do with OEMs, complex parts files, manufacturing plants, that have made it inherently challenging for a lot of businesses to integrate with at scale. And I think, therefore, other businesses that probably you'd associate with kind of fintech haven't probably looked at automotive in the same way that we did. I guess through my background, that we had more intrinsic knowledge about those systems and how you could integrate with them and kind of replicate integrations on with platforms that did kind of cross borders, or certainly had large numbers of customers. By customers, I mean dealerships. So there was clear optimization that we could do. And actually what we found is that there are, while I say the status quo was fairly entrenched, there were actually a lot of businesses that wanted to put their hand up and say, we know there's a different way of doing things, perhaps a more digitally led approach, and also they had a consumer, a customer base, the driver that was to a certain degree dragging them with them because they were experiencing this kind of fintech revolution outside of automotive. So in other
They had a
areas of
Monzo
retail,
account, they had Revolut,
yeah,
they were used to using their phone for things. Why is it that going to my auto dealer is such a terrible experience?
yeah. I mean, I guess, yeah, and it predates a lot of that. So, whether that was them just being able to buy things online far more conveniently,
Right.
or the way that they consumed what were previously kind of big kind of one-off transactions. So whether that was gym memberships, TV licenses, MOTs, you could start to pay monthly. Think about Netflix, what that meant to people and the way you consume media and films, etc., on a monthly basis. E-commerce was getting better and better, Amazon, etc. So like they were experiencing like really convenient ways of retailing or being a customer within retail outside of automotive to a large degree. There's obviously well-known kind of crash and burn story within auto of Kazoo and the idea that you could do car sales entirely online rather than this kind of combination of kind of bricks and clicks, as it's often referred to. That didn't work for one reason or another, but the point still stood that there was a customer driving a car that was experiencing a very digitally led experience elsewhere. They wanted similar experiences in automotive. The dealerships were awakening to that, the dealerships and OEMs, and I think that really helped for us to kind of embrace that kind of change. But it did take a lot of kind of manual intervention to start with, right? There was a very, as I say, physical element to going out, speaking to dealerships, being on site. I remember in those early days when it was sort of just me doing the kind of business development side, driving all around East Anglia to a group of Vauxhall dealerships, somewhere in tiny little quiet villages, convincing their service advisors that this is a good way to talk to their customers about service and repair work and get them to pay for service and repair work. But that snowballed, as I said, kind of quickly from there. And as James said, COVID enforced a digital interaction and therefore transaction, and that really was a jump-off point.
So then take us back to the beginning of COVID when your business shifted. Presumably you weren't able to drive around East Anglia to Vauxhall dealerships at some point. Was there a point when, rather than you driving around, your phone started ringing and then it started ringing off the hook? Was there a time when everyone in your office was doing business development work?
I think it was actually the period kind of immediately after that lockdown. I mean, we lost 95% of our revenue kind of on, what was it, March the 20th or whenever that original lockdown happened.
Yeah.
Very scary moment. The whole country ground to a halt. We continued to service or provide our services to first responders and everybody that fell within that category, etc. But what we saw quickly was that actually there's a recognition people still need to get cars maintained and to ensure they have warranties that are available. There were some extensions that were afforded to that, but car dealers still had to get cars repaired. Affordability became a challenge for many people, but the physical nature of that became the biggest challenge. Ultimately, people couldn't come in and transact, and that's when we did start to see the phone starting to call. It actually was, I don't know, James, if you remember, I think it was the real birth for when we launched Pay Now, because we had one dealer group that rang us and said, it's not about necessarily always buy now, pay later and monthly installments to be paid digitally. They had no way of customers transacting in full remotely, so just a payment link. And they asked us, do you have a product? We didn't at the time. We built one pretty much overnight, shipped that to them. That was a group called Allman Motor Group. They're still with us today, a really, really great long-standing customer. And I guess what's the phrase about necessity being the birth of
the mother of invention?
Yeah, that's it. Yeah, and so that was a really interesting point where we built that for them, and then as you touched on there, Sam, the phone was ringing. Others wanted a pay now as well as a pay later, as we refer to it, Link. And that's when we really started to say, hold on, there's a broader payments play here. So obviously much of the discussion today has been around our BNPL product, still the cornerstone of the business, but we very much are and talk about ourselves as a payments platform or a payment orchestration platform now. And we do BNPL, we do Pay Now, which would include card, it would include open banking, we do physical PDQ terminals. And it was probably, if I think back, COVID, that phone call saying we need payment links, that was probably the start of that kind of launch into a broader, more comprehensive payment platform.
Yeah, we talk sometimes about being wary of scope creep, something that software people talk about, when your client comes to you and says, oh, and another thing. And actually, sometimes with that technical mindset, you can be blinkered away from when a customer comes to you and, that was a gift, right? That was like, they brought that to you.
Bearing in mind, in COVID, I'd have taken anything.
Yeah.
We weren't super discerning.
But that's an interesting point, right? Being able to take a business which has grown successfully and then being able to run it on a shoestring to maintain some revenue, some longevity, and to keep going until hopefully things get better, I think is quite a powerful thing, which is probably unique to digital businesses. I think it'd be difficult to run Costco, for example, at like 5% of their previous year's revenue.
Or even the garage, right? I mean, if you want to do X number of cars on your ramps, you need X number of mechanics to poke and prod them.
Yeah, absolutely. And I think being able to help the retailers get back up to speed as quickly as possible by ensuring that whatever cars were coming through their workshops, they could doing always slightly carefully here, they could ensure people could afford to get everything that they recommended done on their cars, and ensure that the technicians they were paying by the hour to be in those workshops during those lean months were productive for the whole time they were in there, as well as creating a great consumer outcome. And we see that from our Trustpilot scores. We have over 45,000 Trustpilot reviews, average scores 4.8, 4.9 out of 5. And for a lot of people, it might be a distressed purchase, or certainly unexpected purchase. So the verbatims that we see on there are very, very powerful. And they were the sort of verbatims we'd see coming out of COVID, whether that was a first responder or key worker, or I can't quite remember the phrase now, or the term for them, but allowed them to still get to work or, pick up kids from school, etc., because they've got the vehicle available to them. I think when you come out of a period like COVID and you kind of ride those periods with the customer, there's a very kind of strong bond that's built there between us and those dealer groups that we worked with. And as a result, I think we see very, very low churn, little to if any churn, and we work super hard on those relationships to ensure we're not just providing a great technical product, but we're providing a great support mechanism around that as well.
It's fascinating. And COVID, that whole period has shown how to react to the unexpected is probably putting it mildly. We wanted to ask on the flip side, when you thought there was an opportunity or a new market or something to get into that didn't work out, do you have any examples of that, and what fixing it looked like? Is it walking away from something? Is it tweaking it a bit?
Yeah, I mean, I think we've when we're talking about inflection points, we had our Series A, we had this additional capital in. We're then like, right, well, this feels like it's not just a UK problem, this is a global problem. Buy Now Pay Later and Klarna, I guess, and the firm proved that this is a product that can work in multiple markets, if not every market. So we then went, right, okay, well, let's now launch in 2 or 3 countries every single year and just roll it out. It'll be easy. And of course, it wasn't quite that straightforward. And you have regulators setting up companies, employment law in each of these markets, getting debt facilities in each of these markets. And yeah, we certainly didn't scale that fast, and we really, really kind of reined it in and went, well, actually, we want to become, a proper presence in the markets we're in, rather than trying to do a little bit of revenue everywhere. We actually started to rein in our ambitions. And I think probably the biggest mistakes we made were empowering ones ultimately. And I think if we now look at the markets that have been successful, it's been when we get the best team and the right people in place. And again, we probably, whether we were stingy on salaries or going into Germany, it's the motherland of automotive. Without kind of playing on stereotypes, I think trying to get people who've spent their life working in automotive for Mercedes, are they going to start give up their pension and their company car and work for a tiny little British startup? Like it was hard, and I think we probably didn't hire the best people at the beginning. And we learned from that, and fortunately, after a few years of track record, we have registered companies in each of these markets now with GmbH, registered business in Germany, so they have proper employment contracts, stability, pension, all the rest of it. So we've now started to attract great talent, and we have brilliant team members across the board. But in the early days, probably our first hire in Germany wasn't quite right, and then they had their team. Then meant you had 3 or 4 people that weren't quite right. So we certainly made quite a few mistakes there. I think trying to do too many markets at once and probably taking a bit longer to really find that right person in those markets. And then also probably not investing enough. So setting up the structure, the company, the registered company, etc., allowed us to then tap into that talent. So I think that's probably 3 or 4 different mistakes all at once we made. But I guess it's pivoting and learning and adapting to those mistakes.
It's always interesting talking to people about their tech, their finance, business, and a lot of their success or failure points, as you mentioned, they come down to people. So we'd love it to be about numbers and computer code, but really the human side of our entrepreneurial journey is really important. We spoke to a team of 2, but it's still not just one. There's still 2 of them. It's fascinating, and it's probably a temptation many entrepreneurs will be faced with of, I've got this far doing this thing and I can just do it 5 times over in 5 different countries at the same time. It'll be interesting to see as you continue to grow if you keep the restraint and do one market at a time, or you start doing several again.
Yeah, I think we'd like to think we're starting to develop a bit of a playbook for not once you're in a market, but like what are the characteristics of a successful market. So we're in 4 or 5 different countries, and we now have a much deeper understanding of the characteristics that can differ from one country to the next, even if at the surface they appear to be as attractive as the other. But it could be something to do with the cultural attitude towards credit, for example, and how you access credit and the different sources of credit, the cultural attitude to the way that cars are repaired, what they mean to the individual, the way you would talk to the customer about what's due on their vehicle. Equally, some of the regulatory frameworks that are supposed to be there within the European Union that facilitate cross-border regulation. Actually, what do those mean in practice when you try to do that? So I think we have a much better understanding now, and we probably were operating on a much more lean times and lean budget, and therefore we had to cut our cloth accordingly as well. But once I think we start to develop a repeatable kind of pattern for what are the components that make a successful market, and we can identify that key anchor partner, that could be a technology partner, so one of the dealer management systems, the core kind of accounting and invoicing tools that the dealerships run on. Or it could be a commercial partner, so a manufacturer or dealer group that might work both in Spain, Germany, and the UK, potentially. You identify that partner, that's your anchor. You have the technology that will work ultimately. And then, as James said, the team is without doubt the fundamental point. And I guess where you see, going back to COVID, you see technology can survive COVID, right? It just runs, right? It's got no idea the world's in lockdown. But that's when you see people like stress tested to their extreme. And James mentioned Pasha, our CTO, we very much think of him as one of our kind of founding team as well. And then we have another long-standing one of our team called Robbie, who's our COO, former colleague of James at Wonga. Similar sort of character, like, if the shit hits the fan and the world's burning down, that the four of us, you wouldn't even have to talk, right? What's going on. Everyone would be kind of fighting as hard as possible. And that's just one example of the kind of benefit that we've seen from the people side of the business. And again, you learn, I guess, as you hire as well. And without doubt, it's an obvious statement. I know everyone will already know this, but we've seen such a correlation between someone being a recommendation or a referral as a former colleague and their continued success in the business versus cold hires that you don't know. I mean, it's an obvious statement, but it's such a validation for who that person will be, both in in your massive growth phases, but probably most importantly, actually, when you're facing bigger challenges.
Yeah, just take us back to international attitudes towards the kind of Klarna buy now, pay later model, because I think it's crucial to your business, and I think there's certainly a generational level of comfort with something. I'm not comfortable with Klarna. I want to pay for my stuff, and then I want my stuff to arrive, and I don't want a shirts subscription, right? And if I haven't got the money for it, I'll wait and I'll get it next month, right? Yeah. But I also have been a car owner. When I just moved back from the US, where I used exactly right, Almanac. Thank you. I was just getting there. I just moved, as our audience knows, just moved back from the United States, where I bought a car using an online service called Carvana. There was no bricks and clicks, which is a phrase I'm now internalizing. The thing arrived on the back of a truck, and that was the first time I'd seen it, and it was perfect. It was a wonderful experience for me. And I bought a Mini, which is part of the BMW franchise, and 6 months later, I got a ding on my phone, and it was Mini of Manhattan saying, it's time to bring in your car for a service. And I brought the car in, and I went home, took the subway home. And then my app told me what they'd discovered on it. It was a great experience. And then I sold the thing on Carvana again. But when the bill for that service hit me, I had to breathe in, and then I had to pay the whole thing. So how does that, if your business is reliant on people being positive to that attitude, how does it work across countries, and how do you find out?
Yeah, so we research, as you'd imagine, we research new markets extensively before we go in. And I think your broad assumption there about kind of certain kind of demographics or generations will be more comfortable than others. I'm not going to guess which generation you fall into, Sam, on a live podcast. But it's safe to assume that a slightly younger cohort of consumers would be perhaps more comfortable. That being said, we actually see, go back to some of my earlier comments, we see a really broad spread of drivers in terms of age use our products. So our average age of driver that uses us is about 42, 43, which is typically older. I don't know what people's assumptions would have been here, but it's typically older than what people would assume our average to be. I think there's a few factors at play there. And this is where we might differ from, say, BNPL through kind of e-commerce or high street retailing, is that much bigger average transaction value of our car repairs versus someone buying a pair of trainers through Klarna, for example. Equally, that car owner could often have a mortgage, have kids. They're at kind of their peak part in their life, perhaps for their outgoings, as much as they are for their earning potential as well. And as a result, it kind of creates a really kind of positive crescendo, as we would see it, for the use of BNPL, where maybe even that consumer, much like yourself, Sam, wouldn't have used BNPL outside of it, or outside of their car repairs. And that's where we're really careful on the language that we use as well. So we try to use terminology that they'd be very comfortable with, that's very prosaic. It's not trying to come up with a product that is trying to fit a use case elsewhere. It's actually trying to make sure it's completely synced with this environment or this transaction that they're going through. In terms of other markets, Germany, I think, is Klarna's second biggest market. The brand awareness there is absolutely huge. They have something like 20 million active users. It's a massive market for them. They've seen huge growth there. And there was some early BNPL companies that I think they acquired as part of their journey. So we're actually seeing a really positive reception and adoption to BNPL. But that's always only kind of these days one component of our broader product set that includes these other various kind of payment channels. We don't want to leave any driver behind, as it were. So if you're being served that mini repair bill, you might want to use BNPL, but you might just want to pay there and then, right? And so for us, it's about making sure that every consumer that wants to and can transact digitally can do so, whether it's one payment on a credit or a debit card, or through open banking, or if it's BNPL. So we're always trying to make sure we're serving all of those options at that point that would reflect the massive spread of what each consumer's attitude and appetite is for credit ultimately.
Great, thank you. Thanks very much. So just 5 minutes left, folks, before we hand back to Barry to say goodbye. I guess it's fastest finger first question, right? And it's about the future. I'll avoid asking how AI will wend its way into your business. I know that you've already got a good AI story. I'm afraid it's become a bit of a cliche. I'm trying to put a lid on it. But what does your business look like in 5 years' time? Like, where are you at? Is it a broader range of financial services to clients? Is it geographic moves? Is it that there's a big shift in the automotive market that you can see coming that's a headway for you? Where are you?
Well, I would hope that we've IPO'd by then. Yeah, it'll be over 15 years, 16 years since we founded it. So I bloody hope so.
So it wouldn't be you answering the question anyway, right? You'd be out on an island somewhere.
Yeah. So hopefully an IPO there. We next year we're hoping to do 5.5 billion. So we'd be expecting to be doing tens and tens of billions through the platform. By then, definitely be in a few more markets. I'm sure that we're being pulled to North America through some of our tech partnerships and our investors, and likewise in Japan. So I'd expect us to have a large presence in Japan, which is the second largest automotive market after the US. Maybe the US, maybe Canada. So I think certainly we'll be in there. We've also seen that our acquisition of AutoBI, which is a BI tool, which has accounting platform for dealers. We'd expect to see a higher adoption of that product across our network as well. So kind of being a payment platform, but also a data business ultimately, processing huge quantities of data for dealers, but very much staying deep into automotive. Like, we have no ambitions to go outside of automotive. We're specialists there, and we feel like that's our biggest barrier to entry is going deep into automotive.
It's going to be fascinating to see what happens, because if I go back to something you said right at the start, so this potential to capture, I think 40% of repair suggestions, if you like, that the customer's saying no to or won't buy now or will pay later, if you like, getting a slice of that and going to a dealership and saying, look, you don't need to worry, we'll come in, we can do everything's going to be great, and it being backed up with hundreds of customers across tens of different countries. So it's going to be really interesting to watch.
Yeah, and I guess the other element that we're just starting to do is more on the sales side, the car purchasing. We have a tool called a payout tool where we allow dealers to, using our payment wallets, to actually go out and purchase vehicles off consumers. So we see that being a bigger part of the business. We're plugging in asset finance houses, which will finance the purchase of the vehicle and the dealer. We're processing deposits for car purchases and warranties and paint protection. So huge amounts of opportunity in the car purchasing side of the industry as well, which, in terms of TAM, that adds trillions to the opportunity.
Fantastic. All right, James, Jack, thanks so much for being here. It's been a really fascinating session digging into your business bumper. Jon, thanks for being, as ever, a wonderful co-host. Jon, for those of you, Jon is wearing a Christmas sweater. It's just that it's not. Thank you. Very good. So Merry Christmas from us, and we'll hopefully see you before we break for the holidays. And Barry, over to you.
Yeah, thanks for that. So one more time, I'm going to post the link to the chance where you can put all your LinkedIn details in and connect with everyone else on the call, and connect with, of course, James and Jack and Jon and Sam. I'm sure I'd speak on your behalf. If anyone's got any questions, you'd be happy for them to follow up with you afterwards, James and Jack. Yeah, good.
Absolutely.
And just one final thing on that. Is there anything that you need, either from the people that are still on the call, or we will distribute this afterwards, any introductions you'd be interested in, any particular areas you'd like? We found on the last two, but maybe the last three, the guests have actually either found connections and potential customers or other kind of investors and areas. Is there anything in particular that you would be interested in introductions or connections, or anything that we could do to help?
Well, I mean, sorry, James. Yeah, I mean, again, obviously, on the topics that we've touched upon, we're constantly running processes where we're interested to speak to investors that are involved in the mobility or the fintech space, and equally, if people have connections into that, we'd certainly welcome that. And more broadly, those that I think have scaled, we're always keen to learn from those that have been there and done it. So those that have scaled, I guess, similar businesses ideally, but it doesn't really matter. But those that have scaled businesses across different countries, I think are always, we'd love to kind of speak to them and learn what they've done and how they've fared, and equally some of the challenges that they face. But for us, we don't want to have to reinvent the wheel where others may have done that. So if that's scaling SaaS businesses or payments businesses, again, we would love the opportunity to speak to similar businesses.
Fantastic, brilliant, guys! One more time, thank you so much for today. Hope you'll come back and keep us posted on the journey, on how it's been, over time. And we'll see everyone next week. Next week we've got my time and Paul Budgeon, and that's the same time next Tuesday. So, guys, enjoy yourselves.
Great.
Thank you.
Thanks, everyone.
We'll see you.
Thanks, everyone. Thanks, James. Thanks.